Hey traders, how are we all? It's been a while. Alright, so in this video I wanted to touch upon just this one very important question. And this will lead you back to your criteria, lead you back to the methodology that you use in doing technical analysis. And the simple question is, why is it that you do what you do for technical analysis or in technical analysis of your charts? Okay, I want you to think about that for a moment. The simple answer to why we engage in technical analysis is simply to determine the trend. That's it. There's nothing else. There's nothing more that we need to determine from that. Once we can determine the trend, that's when we then start to apply whatever rules of engagement that we have, which would be whereabouts our entries are going to be and whereabouts our exits are going to be. Okay, and this applies to both Forex and to binary options. So what I want you to do is go over your way of trading, your way of thinking, how you approach trading, go over your methodology, go over your criteria as well for your trades or your strategies, and then look backwards from this standpoint of what I've just said, of that your technical analysis is simply just to determine the trend. That's it. And if you are a technical indicator trader, meaning to say that you rely on a number of technical indicators to engage in your entries, I'd say go back and study that. What is it about your technical indicators that reveal to you that this is where the market is trending? Now, if you were to look at your screens right now, USD CHF on a 15-minute chart, what I would possibly get from many traders is to say, okay, I can't make sense of most of this, but here's the market trending up. In real time, you wouldn't have known that, right? In real time, none of this gibberish in front of me makes any sense for us to be able to engage in an entry anywhere. Okay, this is where you would begin to lose money. This is where speculation comes from, right? We could have said, yes, the market is establishing patterns around the EMA 50. We could have made sense of any of this and said, hey, this is a massive W formation. If we did, you'd also have to absorb quite a heavy drawdown with all of these movements here. You could have also said, yes, price came down and hit the EMA 200 and created a wick and then climbed again for a while, right? That's also true. But is that enough for you to be able to confidently take an entry right that way for how many of the pips that you're looking for, and then be able to close off your trades without having a heart attack? Absolutely not. Things are different when you're doing micro lots and you're doing mini lots. But once you start hitting full standard lots and then also then climbing your way up to 5 standards, 10 standards, things become much, much more complicated. And the complexity there, where that sits, is in your own psyche. It's how you're going to emotionally respond to that. And it doesn't matter how strong your character is, when you're putting 10 standards onto a trade and that market draws down, say, 20 pips against you, you're going to have to, in that time, absorb $2,000 or thereabouts, depending on currency pair. And so, for a lot of people, they can't handle that. So that's where you will end up losing trades, right? But if you then approach, or if you started to approach your trading from the standpoint of saying, whatever methodology I employ in trying to decipher whatever it is I'm doing on the charts, if that methodology gets me to a solid conclusion that this is the direction in which the market is trending, right? And then you use that information to then execute an entry for yourself that has minimal drawdowns, you'll never go wrong with your trades. This is where, when I'm saying, let the market coerce you to fall in love with it. Let the market play hard to get with the market. Let the market come to you. Let it do its thing for you, right? And when it does that, what that often means is that it will come back and confirm whatever your instincts were. It will confirm whatever your prediction is in regards to a particular directional move in the market. So go back, re-look at all your methodologies, your criterias, your strategies, and then ask yourself if everything that you do in your procedure, if that is engaged in a manner in which all it does is that it gives you a trend bias, and it gives you an indication as to a possible entry. If that's what it's doing, fantastic. You don't need to do anything more. But if everything you're doing actually focuses your attention elsewhere, then what you need to do is to reestablish your methodology, reestablish how you look at your charts. Okay? Because when you're caught up in things like this, and you're desperately looking for an entry where the market's going sideways, you're always going to find yourself in a losing position. Always. Right? Even if you look at something like this where the market has drastically moved up, and then you go and investigate what the market did previously, and you say, well, I can't really tell that this market was going to go ahead and do this. Okay? If we can't tell that this is what the market was going to do, then you simply don't take an entry. That was not your entry. Okay? So what we want to do is to understand that, like, for example, here, if I was to look at this and say market bounced off the EMA 50, and say, for instance, we took an entry off the continuation pattern here, right? And we say, hey, you know, that was very close to 15 pips. All I needed was 10 maybe. Yeah, that's true. You could have added 15 pips. But how would you have known that this market was going to actually trend in that direction? If you can decipher the trend, you know that that market, depending on currency pair, has the potential to run anywhere from about 70 pips to, you know, maybe 150, close to 200 pips, right? If that is an official longer term trend, like for example, the market enters into a channel or possibly even breaks out of a channel, we're talking over the course of 2 or 3 days, we're talking anywhere from 200 to maybe 300-400 pips again, depending on currency pair. All right, let me show you this. Pound AUD. This was let's go here. I want to show you this. This was a signature trade. Absolutely beautiful. Market entered into a channel, right? And how this channel sits, we need to jump onto a 4-hour chart to see that. Market is in a downturn, and then we enter into a channel, right? What we're looking for is we're looking to sell the highs, right? If we are not swing traders in a channel, that's okay as well. What we're looking for then eventually is, let me jump on a 1-hour chart to show you how beautiful this trade was. We're looking for a breakout, right? A lot of these traders here, what they'd find is that as soon as the market breaks out, maybe does a retest somewhere up here, people will start selling. Yes, you could sell. Sometimes the market will just go straight down, which isn't a problem, but keep in mind, there's always going to be room for drawdown because you don't know how long this market's going to hang this channel line here, right? But look at what happens roughly about a day and a half later. Price comes down, then revisits the EMA 50, and this beige line up here that you can see, this is what I add when that beige line and this red line, I tend to add when I'm doing trades in a very rough environment, right? And what I mean by rough environment is just look at how the markets have been the last 3 months or so. So in this case, what happened was price went up on a 1-hour chart, did 2 hits to this EMA. This beige line roughly means for me, it's the EMA 800, which is the EMA 200 on a 4-hour chart. So when I see that, I don't have to jump from time frame to time frame. All I can do is say, okay, from this chart alone, I can say that price has just hit the EMA 200 on a 4-hour chart, and then we get this aggressive candle going south just before New York Open. Okay, if I then jump onto my 15-minute chart for an entry, okay, my entry would have been here after this massive confirmation candle, 2 or 3 hits to my EMA 200 on a 4-hour chart. Market starts coming down. I take my entry off of here. Okay, and at this point in time, with high volume, New York Open, that EMA 50 means nothing. So you can take your entry confidently. First candle, we're getting 20-something pips. Second candle, the low of the wick is about 68 pips, correct? What I wanted to show you, though, is that from that channel breakout, this retest confirmation, and the manner in which this market has moved, Once we time that perfectly and we're able to confidently say, what I'm seeing here is a channel and then a channel breakout, and when the channel is when the market is channeling up, I'm expecting a breakout below the low, and when it does, this market is going to establish a new trend. That's the whole idea of the analysis there. And when you're looking at this channel itself, this channel lasted for possibly a number of weeks, right? So we're probably talking maybe roughly about 3 weeks. We waited for this setup to happen. But once it does happen, it actually gives you the potential to ride away for quite a lengthy number of pips or a lengthy period of time. So from that entry point here, just to the actual low of the Asian session the next day, we're talking 200 pips. These are the king tides or the tsunami waves that we want to ride. And that's why I'm saying that what you've got to do with your technical analysis is that you approach it from the standpoint of understanding that the whole goal is for you to determine the overall trend. And I'm not talking about the trend on a daily chart, because here's the thing. If we looked at this daily chart, we can say, yes, from 2015, the market's been trending down aggressively. But these corrective waves here, where in this case, the market probably would have lasted for maybe 2 weeks, we're talking about there close to 2,000 pips, right? Look at that, 20137. So close to 2,000, well, just over 2,000 pips in that time period, although the market's been trending down for that whole 2.5 year period. So in doing so, like even when we're channeling up, you can make a number of trades here, bank a number of pips, which is against the official trend on a daily chart, but you can still ride that on a 15-minute chart and then go with it. Here's the other thing though, is that if you are then riding the overall trend, know that markets are going to channel up in this direction and the overall trend is down, so the market's going to eventually break out to a low beyond this point here, right? And what you could do is use your fib expansion tool, okay? And we'll just expand out to this being the 100% mark there. Where is this price most likely going to go to? Our 1618 line. So if you were to trade this breakout and do it in the manner in which I said it, where you don't just take an entry straight off the line itself, you wait for a retest as the market did on the EMA 200 off the 4-hour chart, but you do this on a 15-minute chart, so you get your entry very, very early on. But if you were to do that, say for instance somewhere in the middle of this, all the way down to 1618, we're talking about 504 pips. How many days would that have taken you? 1, 2, 3, 4, 5, 6 days roughly. 7. 6 days here at the bottom of this week. So 6 days, that's a week and a day in a trading week, and you've just made 500 pips. That's the whole idea of being able to decipher a trend properly. That is what you want to do. Even if you're trading binary options, when you know the market's trending in a particular direction, the bulk of your binary trades should be in line with that actual trend. Okay, that's what I want you to do. Please go revisit your methodologies, try and understand this point again. And I say this for the last time in this video. The whole idea for you to do your technical analysis, follow your methodologies, and even your fundamental stuff is simply just to decipher the actual trend of the market. And there's nothing else. Don't waste your time doing anything else with that. You're not looking for anything else. If it takes you half an hour to determine that, so be it. If it takes someone else a minute to determine that, so be it, right? Constantly refine that process, because the less time that you spend doing that, the more time you can spend doing other things. You'll know when to take your trades. You'll know when to a way to do your entries. Okay, so that'll be enough for this video. In the next one that I create, which should be today, I will run through I'm going to run through the roughness of the markets, how to handle that, and I'm going to talk you through practically all of my entry points or focal points when it comes to wherever I start paying attention, maybe like even the kill zones. Okay? All right, I need some water. All right, guys, bye.